Alright, hello, and welcome to Camel Finance. I'm your boy Camel, and today I'm going to be talking about financial clown world. Markets these days are insane. So I want to talk about where we are, how we got here, and where we are going. Over the past few years, we've seen huge stimulus following the C-19 era. We've had inflation problems, the most aggressive interest rate hike cycle that we've ever seen. We've had a war in Ukraine, sanctions against Russia, a move away from the petrodollar system, a banking crisis which is still unfolding, a possible move to a new type of cashless digital CBDC system which is likely just around the corner now, and this is just to name a few. It's difficult to know what's going on. Much of the data we get, such as the CPI, we know is manipulated, and some of the data is just simply removed from the Fed's reported data set, such as M2. So here is M2. As you can see, they discontinued this. Now, full disclosure, I'm being slightly hyperbolic pertaining to M2 because they didn't completely get rid of M2. What they did was they replaced M2 with M2SL. So what we did was we went from reporting the M2 every Monday to only once a month. We live in this financial clown world, and I want to start by asking you a few questions. Do you trust the data that is available to us? Do you trust the Fed? Does the Fed have our best interest at heart? And is your bank currently solvent? Remember, the Fed recently printed money. They gave it to banks and told them to buy bonds, promising they wouldn't hike rates. In fact, they promised they would keep rates near zero all the way until the end of this year. Then, just 3 weeks later, they embarked on the most aggressive rate hiking cycle of all time, forcing banks to sit on billions in unrealized losses. So was this an accident? Was this incompetency? Or do you think this might have been intentional? So I want to back up now and talk about how we got to where we are today, because that will likely help us in determining where we're going moving forward. QE1 started all the way back in 2008. QE, of course, being quantitative easing. This is the printing of money and using it to prop up markets. And you can see here from CNBC, the Federal Reserve, over more than its century-long existence, has emerged as a leading force in the stock market. This stature was bolstered by the central bank's adoption of two unconventional policy tools in the 2000s, large-scale asset purchases and forward guidance. So, as if printing money and propping up the markets wasn't enough, they also lowered the interest rates to zero and then to negative. So you can see here, central banks saying negative interest rates have been effective. This makes money free to borrow. So it incentivizes banks and institutions to borrow money and invest it in the markets, which results in a double whammy of stimulating markets. And as if that wasn't enough, then we had MMT, modern monetary theory. MMT was this experimental process, this experimental thing that was largely contained to a few textbooks and discussions within small circles of economists, but it somehow found its way into our real life economy. The theory boils down to this. A country with its own currency does not need to worry about debt because it can fund the debt through opening money taps, nor does it need to worry about hyperinflation. According to MMT, it's not the amount of money that determines the rate of inflation, but the extent to which an economy uses the potential of workers and its productive capacity. Since the pandemic, governments have pumped billions into the economy and taken on debt in vindication of MMT-style monetary activism. So let's put this more simply. MMT essentially states, governments do not need to rely on taxes or borrowing for spending, since they can just print as much money as they need, as they are the monopoly issuers of the currency. Since their budgets aren't like regular households, their policies should not be shaped by the fears of a rising national debt. So of course, just like this, we're back to financial clown world. We have seen the debt balloon to $31.5 trillion. And apparently we don't need to worry about this thanks to MMT, because we can simply just print more money whenever we run out. So in summary, don't worry about the debt, because we can always just print more money. And of course, it gets even more clownish here when we see that Congress has to raise the debt ceiling. They take on debt until they reach their limit, and then they just move the boundary. They just move the debt ceiling up so they can continue to take on more debt, which of course they continue to attempt to service by printing more money. Truly clown world financials. So from QE1 and MMT, we then have this pandemic. What was once a conspiracy now seems to have been accepted. So you can see here the lab leak, most likely the origin. This is far beyond the remit of this video to say any more on this. But I ask you again, do you trust the government, the banks, the information, the news, the data that we are provided with? The facts are the facts. The pandemic did trigger a tsunami of printing and stimulus, including printing money and giving it to citizens. The government moved to this insane policy of printing money and giving it to people, giving it to the citizens to quiet them down. By the time we got to March 2020, the Fed then moves to announcing unlimited QE and sets up several new lending programs. Stocks and Bitcoin put in V-shaped recoveries as a direct result of this because they were printing an unlimited amount of money and then using it to prop up the market. So you can see the Dow here made a massive V-shaped recovery, and Bitcoin's V-shaped recovery then ended up front-running the unlimited amount of QE that was soon to follow. It's unsurprising then that inflation starts to run wild, as you can see. Right around the time we get to unlimited QE, inflation starts to ramp up. And of course, these numbers are around half of the real world numbers since they manipulate the CPI data. We were assured by the Fed that inflation was transitory for a very long time. We were assured that it would just be a short period of time. There would be minimal or nominal impacts of this small bout of inflation. Of course, this turns out to be one of the worst inflation calls in the history of the Fed. So again, is this incompetence, or is something more sinister going on under the hood? So QE, printing of money and propping up markets, continues all the way into 2022. And we can see that here from the Fed balance sheet, just ballooning all the way into Q1 of 2022. Of course, we know there's a correlation between the Fed balance sheet expanding in orange here and the stock market. By Q1 of 2022, we see the Fed start to taper the balance sheet, start to reduce the size of the balance sheet, and we enter the bear market of 2022. So we went from the printer running at full speed, expanding the balance sheet, and negative interest rates, which was as easy as monetary policy could be, as accommodative to markets as could possibly be, to the printer off, reducing the balance sheet, and aggressive interest rate hikes, which were for a while as tough as could possibly be. Last year, 2022, was a hard year for most traders and investors. The stocks declined, with the S&P 500 down around 20%, but they didn't crash like 2008, as most expected. Shorts got hurt many times during the violent counter-trend rallies. And then, to make matters worse, bonds did not perform as they typically do in bear markets and recessions. We had TLT losing nearly 30%, and even gold finished just about flat for the year. It was up less than 1%. So where are we now? Well, 2023 is shaping up to be a lot better. You can see here the Nasdaq, the S&P up 21 and 7% respectively. We've got Bitcoin up around 70% on the year. Even the 60-40 portfolio is performing reasonably well, given that we're only 3 months into the year. We've seen the return to balance sheet expansion, with the Fed undoing 70% of its quantitative tightening, its balance sheet reduction in just 2 weeks. Risk assets such as the Nasdaq and Bitcoin have benefited from this newly expanded Fed balance sheet. Inflation is coming down for now, at least, as you can see from the CPI metrics. We have another one coming up next week. It will be interesting to see if this trend continues. The rate hikes are likely close to being paused or cut soon. You can see here, this is the July probabilities. The expectations are that we are either going to see a pause or a cut, with only around 1/3 suggesting we will see another 25 basis point hike between now and July. So this rate hiking cycle seems to be close to finishing. The bond market seems to have known something for a while. The Fed funds rate has crossed above the US 2-year yield, and historically a Fed pause has always followed. So you can see the Fed funds rate in orange. Whenever the Fed funds rate crosses above the 2-year yield in green, historically speaking, the Fed has paused rates and held them there for a few months before then moving to a cutting cycle. This is the exact set of conditions that we have today. This suggests that a Fed pause in rate hikes is coming in the not too distant future. So the question remains, where are we going for the rest of 2023? A lot of investors are championing this idea here that we will see a 2008 style plunge. This is certainly one possibility, and we have to remain open to all outcomes. I personally proposed this melt up thesis back in the summer of last year, and since then, there's been multiple times where it has looked silly and multiple times where it has looked encouraging. As it stands right now, at the hard right edge of the chart, this is starting to look considerably more encouraging than it has done. The facts are the facts and the data is the data. This is the dollar index, the DXY. The DXY is clearly in a downtrend. It has lost the upward sloping red support line, the blue one, and now it is just breaking down of this long-term upward sloping purple support line. Things can change and they can change quickly, but as it stands, the dollar continues to be under pressure. The Nasdaq, as you can see, has repaired its bear market blue trend line from 2022 and is since making nothing but higher lows and higher highs. The Dow has a little bit more work to do, but is undeniably making technical repairs across the board. This simply speaks to probabilities that we should be open to better than expected outcomes for the stock market. We also have Bitcoin up around 70% off of its lows, having broken out of its bear market resistance line. And so if we can continue to see some easing, or at least reduction in quantitative tightening, that is to say, if the Fed can back off a little bit from its rate hikes and from its balance sheet reduction, then we have a good chance at better than expected outcomes in the stock market and other risk assets. The Fed still has the power to spoil the show, and I do wonder if we could see a controlled demolition so that they could usher in their Fed Now CBDC system. The Fed Now is technically not a CBDC as it is not based on a blockchain. However, it does have all of the totalitarian and dystopian capabilities of a CBDC. The only way we can get through this is to remain flexible and open to all outcomes. No one knows what's going to happen, especially as these are unprecedented times. We have clown world MMT, unlimited debt, and fake data to deal with. We've got to accept that we know only that we do not know, trade what is in front of us, knowing we might have to pivot our expectations any day now, only to reverse them again if the charts tell us something new. For now, the facts are the facts. The lows have been in since October, and we have continued to see further upside, making higher highs and higher lows across the board. So long as that continues, the trend is your friend until it ends. I'm your boy Camel. I hope you found value here today. I hope you enjoyed this presentation, and I look forward to going into next week, as always, with no bias, no expectation, no emotion, and continue to trade the chart in front of us.